Well, good morning. Devendra Rana here. The topic of the day is cross-border reinsurance transactions. Cross-border reinsurance transactions. The cross-border reinsurance transactions, or in short, CBRs are reinsurance transactions between an Indian insurance company and a foreign reinsurance company that is established outside of India. So the Insurance Regulatory and Development Authority of India regulates reinsurance placements of Indian insurance companies but not cross-border reinsurance transactions directly. Here are some things to know about CBRs. First of all, filing a reference number. Before an Indian insurance company can transact business with a CBR, that is cross-border reinsurance, a filing reference number is required. So the filing reference number is a type of annual license. Then collaterals. The IRDAI is proposing to require collaterals for insurance transactions with cross-border reinsurers starting in the financial year 2025-2026. So the collaterals could be letters of credit, cash, trust arrangements, or other securities. The purpose of the collaterals is to protect the interests of policyholders and insurers. The purpose of the collateral is to protect the interest of policyholders and insurers, increase market confidence, and attract more reinsurers. So reinsurance is a key capital management tool by insurance companies. It allows insurers to transfer a portion of their risk, which increases their capacity to underwrite more risk. Now, in the global landscape, India emerges as a burgeoning insurance and reinsurance market with immense potential. With its rapidly growing economy and expanding middle class, the country presents attractive opportunities for insurers and reinsurers seeking to tap into its vast market. So, a clear insight into the legal and regulatory considerations when engaging in cross-border reinsurance transactions involving India is however imperative for navigating complexities and ensuring compliance. So, the key legal and regulatory aspects which must be factored when considering reinsurance transactions involving India or elements of Indian risk should be known to us, because the transacting insurance in India means India is an admitted jurisdiction, and the expectation is that all Indian risk must be insured with registered insurers in India. So the insurance sector is primarily regulated by the Insurance Regulatory and Development Authority of India, which operates under the purview of the Ministry of Finance. So the Insurance Act 1938 unequivocally prohibits non-admitted insurers from carrying on insurance business or insuring property situated in India or any ship or other vessels or aircraft registered in India. So, in view of this, insurance programs of multinational corporations which involve elements of Indian risk must be carefully structured under local laws at the stage of both policy underwriting and claim settlements. So, fronting arrangements, that is, arrangements where an Indian reinsurer cedes or retrocedes most of or all of the assumed risk to a reinsurer or retrocessionaire, are prohibited and frowned upon by the IRDAI. So, as of April 2024, there are over 54 Indian insurance companies, excluding those only transacting reinsurance, many of which are joint ventures between Indian conglomerates and large foreign reinsurance players. So, foreign direct investment of up to 74% has been permitted in Indian insurance since 2021, that is, prior to which only 49% was allowed. So, additionally, the solicitation or distribution of insurance is highly regulated, and foreign intermediaries must have a clear understanding. Or distribution of insurance is highly a clear understanding of the regulatory framework involved. So, in case of high value insurance claims, while it is not customary for insurers to appoint their own loss assessors, insurers often engage legal counsels in early stages to help them navigate claim assessment and settlement process with Indian insurers, since non-standard deductions, delays in claim settlement, and technical deputation of claims are not uncommon. So there are several forums that can be approached, and the strategies for addressing claim-related disputes need to be arrived after careful consideration of the insurers involved, nature and complexity of the claim. So prior practical experience and adopting the right strategy play an important role in achieving best results in claim settlements. So while transacting reinsurance in India, 6 categories of reinsurers can participate in the Indian reinsurance market. Reinsurance companies incorporated in India, presently only GICD, branches of foreign reinsurers, that is FRBs, Lloyd's Syndicate operating through Lloyd's India, International Financial Services Center insurance offices which are set up in the Gujarat, International Finance Tax City and regulated by the International Financial Services Centers Authority, that is IFSCA, which is unified regulator of all financial institutions present in the IFSC. Then Indian insurance companies for inward insurance business, inward reinsurance business, and cross-border reinsurers. So notably, except for cross-border reinsurers, all other categories of reinsurers have a place of business in India and must be registered with the IRDAI other than IIOs. So Indian insurance regulations are complex and require a specific order of preference to be followed among the various categories of reinsurers. So in long-life sessions of Indian cedents, the overriding intent of the regulation is inter alia to maximize retention within our country or within the country, develop adequate capacity, secure interests of Indian reinsurers, and prevent fronting arrangements. So cedents are required to offer GIC Re a prescribed percentage of the sum assured of each general insurance policy as a mandatory cession. So currently 4% of the sum assured it is. CVRs, that is a foreign reinsurer whose place of business is registered outside India and which is supervised by its home country, are not directly regulated by the IRDAI. So the objective of the IRDAI's regime is to monitor reinsurance placements of insurance companies regulated by it. And a filing reference number, that is a form of annual license, must be generated for each cross-border reinsurers before cedents can transact business with the CBR in any given financial year. So there are various entry routes for accessing or establishing in the reinsurance market. The pros and cons of the legal regime associated with each option have to be cautiously evaluated apart from the operational and commercial considerations. So in February 2024, the IRDAI released an exposure draft on its guidelines on collateralized reinsurance transactions for placement of reinsurance business with cross-border reinsurers. So the stated intent of these guidelines is to fence the interests of Indian cedents to maintain their ability to meet obligations towards policyholders in the backdrop of increasing shares of CBRs in the Indian reinsurance market. So it is proposed that all Indian cedents placing reinsurance business with CBRs in the Indian reinsurance market, it is proposed that all Indian cedent placing reinsurance business with CBRs collect collateral from the CBR in the form of either an irrevocable offer of credit or an irrevocable letter of credit, that is from the CBR, or premium funds withheld by the ceding insurer. So the letter of credit may either be in Indian rupees or in any freely convertible foreign currency and issued through any IFSC banking unit in GIFT IFSC or a scheduled commercial bank in India, in the manner prescribed. So it is presently not clear if such norms will be implemented. Another trend to be noted in this jurisdiction is that in the past few years, the sector has witnessed frequent and significant reforms in the regulatory framework, with the Indian reinsurance sector progressively moving towards a principle-based regulatory regime. In conclusion, transacting cross-border insurance and reinsurance in India requires a nuanced understanding of the legal and regulatory landscape. So despite the regulatory challenges, the Indian insurance market presents numerous opportunities for their growth and innovation. So as far as this cross-border reinsurance is concerned, or cross-border reinsurance transactions are concerned, there are IRDAI guidelines that were issued on 19th January 2016. The guidelines are revised in order to make it aligned with the amendments in the Insurance Act 1938 and the regulatory prescriptions made by the authority with respect to registration of branch office of Lloyd's and other foreign reinsurers. So the revision is being made in order to streamline the regulatory process with respect to cross-border reinsurers. These guidelines, as it is, are issued by the IRDAI under the powers granted to it under Section 14 of the IRDAI Act 1999. So the guidelines helps the reinsurers because the reinsurance business transactions, which are cross-border transactions, has to be made under certain guidelines, norms or regulations. So the IRDAI is considering the introduction of collateral requirement for reinsurance transactions with cross-border reinsurers. And these transactions will be now governed by the IRDAI. So the transactions monitored by the IRDAI will reflect the collateral amount also, because that is important. So in a move aimed at enhancing the stability and risk mitigation measures within the sector, the insurance regulator is considering the introduction of collaterals within the insurance sector. So the draft paper is open for next 15 days, because the IRDAI has released a draft paper on collateralized reinsurance transactions for reinsurance business with cross-border reinsurers. So in a move to aimed at enhancing the stability and risk mitigation measures within the sector, the insurance regulator is considering the introduction of collaterals within the insurance sector. So addressing the potential counterparty default risk or counterparty default risk, the exposure draft will be applicable for all the reinsurance placements with CBRs from financial year 25-26 onwards. However, the draft paper is currently open for seeking public consultation, inviting feedback and insight from the stakeholders in the insurance industry. Because reinsurers are key capital management tools that play an important role in risk management for reinsurers. So according to IRDAI, 283 companies were participating in the Indian cross-border reinsurance business, competing with PSU reinsurers, GIC Re and foreign reinsurers branches. So as per the proposed guidelines, insurance companies placing reinsurance business with cross-border reinsurers will be entrusted with the responsibility of collecting the collateral, which can take the form of either an irrevocable letter of credit or premium funds withheld by the insurer. So this letter of credit shall be issued through the IFSC banking unit in GIFT or IFSC or a scheduled commercial bank regulated by the RBI, which this cedent can choose to accept this letter of credit either in Indian rupee or in any freely convertible foreign currency. The amount of collateral required will depend on the credit rating of the CBR. So the amount of letter of credit shall be with reference to the aggregate of outstanding claims, liabilities and incurred but not reported reserves of the ceding insurers, that is cedent, for insurance contract or arrangements with the concerned CBR. For CBRs rated A or above from S&P or equivalent, the collateral amount will be set at 80% of outstanding claims plus IBNR. So meanwhile, for CBRs rated below A, the collateral requirement will increase 100%. In the case of premium funds withheld, the minimum amount of premium or fund withheld shall be 50% of the premium ceded by the insurer to the CBR. The insurer will release such collateral when the liabilities of the concerned CBRs are fully extinguished. However, if liabilities are expected to persist, insurers can release collateral after making necessary adjustment for any outstanding amounts. It's noteworthy that insurers cannot account for collaterals in their solvency margin. Thank you very much.